All right, we'll call to order the meeting of the Longview Firemen's Relief and Retirement Fund. Denote members present. Pam, do you have the name of the guest in the crowd?
Yes.
All right. Citizen comment. Either of you gentlemen
Come on up.
have a comment? All right. Little house rules. Anybody that does have any questions or presentation, if you'll just please come to the microphone for the purpose of our recording. It makes it easier for people to understand what's being said. So with that being said, we'll move on to item A, presentation of second quarter pension performance. Will Harrell and Charles Smith of Robert Harrell, Inc., and I believe they are online via Zoom to make their presentation. Will, you have the floor.
Good morning, everyone. It's nice to be with you this morning. We're coming to you live from Galveston Fire's Pension Fund Conference Room, and we do appreciate the flexibility. It was also great to see those of you who made it to San Antonio. It was nice to break bread and look forward to the conference in Telfra. So we'll start with the market commentary for the first half of the year. After gaining 26.29% for 23, the S&P ended the second quarter up 4.28%, and the first half of 24 up 15.29%. At this moment, that index is up a little over 18% year to date, keeping the index firmly in bull market territory. Since 1960, the index's average annual performance during an election year has been positive 13 out of the 16 times. And as of halfway through 24, the total return on the S&P was 24% for the trailing one-year period, 10% per year for the last 3 years, 15% per year for the last 5 years. And of course, that includes the pandemic in 2020 and the S&P's dismal performance in 2022, negative 18.55%. Small cap stocks, best represented by the Russell 2000, were up just 1.73% in the first half of the year, but have since rallied and are currently up 10.6%. So effectively, small caps and mid caps are up about 9% from the end of the second quarter on hopes of interest rate decreases, because so much of the debt in those sectors is floating rates, so that they rely very heavily on debt financing. They cannot issue bonds, and they just don't have the cash flow or cash reserves of larger companies. After finishing 2023 up 5.5%, after, of course, being down 13% in 2022, the bond index ended Q2 just basically flat. The index, however, has, quote, rallied 2.78% since June 1 on lower inflation data and weakening labor data. And in fact, I'll get to the labor numbers, but I'm sure you have seen in the newspaper or the internet that the jobs number was overstated by the administration by 818,000 jobs. So we expect the unemployment rate to continue to tick up. June inflation data came in at 3%. I believe July was 2.9%, down from 3.5% in May, though, again, very, very sticky inflation. The yield on the 10-year Treasury note ended the quarter at 4.43%, but it had dropped when I wrote this a few weeks back, I guess middle of July, now a month ago. That had dropped to 4.23% when I wrote this. At the moment, it's hovering around 3.8 to 3.9%. And that is what we've discussed many times before, that those are bond purchasers, those are bond investors that believe now that we have reached the top of the rate hike cycle and are more likely to have lower rate bonds, lower yielding bonds a year from now. Thus, they are picking up all the current bonds they can get their hands on, driving yields lower and the value of each bond higher. 23 was the first year on record since 1962 that the yield on the three-month U.S. Treasury bill was greater than the yield on the 10-year Treasury note for an entire calendar year. In fact, the spread between the 2 and the 10 slightly deepened its inversion to negative 47 basis points in the second quarter. And basically what that means is that historically that has predicted or been a pretty good predictor of recessions. And conveniently, we get to the next bullet point, which is GDP. It only grew by 1.4% in the first quarter. It was initially stated at 1.6 and then revised down to 1.4. But if you go back to 2023 and just look at the trajectory of GDP, the third quarter was 4.9%. The fourth quarter was 3.4%. The first quarter of 24 was 1.6, then 1.4%. And then the recent estimate of GDP came in at 2.8% for Q2. However, 2.8 seems like a great bump from 1.4%. However, 2.2% of the 2.8% was non-defense government spending. Therefore, what we're seeing is a lot of government spending propping up this economy. We're also watching the unemployment, and the long-term average is 3.19 for GDP. So what we're watching is government spending accelerating and supporting the economy instead of the consumer, which is how it should, how it's normally, it's about 67 to 70% consumer spending, not government spending. We're watching the unemployment rate. It climbed to 4.1% in June, up from 3.8. Inflation is still sticky, and we would suspect that there is plenty of volatility to be had between now and the end of the year. And it'll be interesting to see what that 818,000 jobless revision will do to the unemployment rate. And Charles also mentioned that there was actually a hurricane factor in the jobs number as well. Our clients are fully invested, diversified, and rebalanced diligently. Since we met last, the portfolio had been completely rebalanced towards the end of June. All those trades had settled by the end of the quarter. S&P was up 4.28% for the quarter, up 24.5% for the trailing year. The bond index was flat for the quarter and up 2.6% for the trailing year. International stocks were flat for the quarter, up 12% for the trailing year. Emerging markets were up 5% for the quarter and up 13% for the trailing year. The TIPS index was up 79 basis points for the quarter and up 2.71% for the trailing year. Oil closed the quarter at $83 a barrel on the New York Mercantile Exchange, up 16% from $71 at the end of 23. And you've seen oil pull back a bit. That's not because we're producing more. That's because demand for oil is weakening. So if you add all this up, you've got unemployment rising, inflation very sticky, demand for oil dropping, this inverted yield curve for over a calendar year, and the trajectory of GDP. Again, we would not be surprised if we were in for a rocky end of the year. All righty, we'll jump right into the investment performance and allocation analysis for period ending June 30. Let me back up just a bit more. All right. As of June 30, the total balance of the Longview Firefighters Relief and Retirement Fund was $96,574,041.04. There was 62%, or roughly $60 million in equity fund, 2.5% allocation to hedge funds, 1.2% to alternative funds, and fixed income 32%. And then also the cash in the portfolio was right at $1.5 million for that grand total of $96.5 million. Let me back up just a sec. I have an update as of yesterday. Thank you, Charles. I'm working my keyboard over here. So as of yesterday, the new balance for the fund was $100,282,571.44. Pretty exciting watching this fund grow as it has. Obviously, the POB played a major role in that. We have some some news on that. Actually, if you recall, the pension obligation bond was funded almost exactly 2 years ago, and it was during a real tempest of a stock market during 2022. And during the depths of that stock market, the committee decided to move forward and dollar cost average that money into the market, into its weighted portfolio over a 3-month period in pretty large tranches, about $16 million, as I recall, a piece. And that has paid off handsomely for the fund. I'm happy to report that if you just isolate the $46 million from the pension obligation bond, that money has grown in 2 years' time by 19.74%.
Great news.
And all right, whoops. All right, back to the report. All righty. This page here is a graphic representation of the prior page. I would just comment that it's a highly diversified portfolio from large cap and mid cap and small cap, some real estate, both private and publicly traded, internationals, but not too much, about 13%, some alts over in this region right here, something we might be adding to here in the not so distant future. Guggenheim, PGM, your two total return bond managers, Blackstone Breads, JP Morgan Global Opportunity, MetWest Floating Rate Fund. That's a fund that I feel like I mention every quarter, because at some point rates will continue to come down in earnest, and the utility of that floating rate might have exhausted itself, but that's a discussion for probably the spring of 2025. The asset allocation by asset class, it's 44% domestic equity, 9% international equity, 5% real estate, 5% emerging markets. So together that's right about 14%. 32% fixed income, 4% alternatives, and 1% cash. Now we get to the unit value page, starting back in 2011 with $43 million. And, 2015 off 6%, 2016 up 3%, 17 up 13.6. You see the inflation number here, pretty tame along the way, 73 basis points, under 2, right at 2, right at 2, negative 3.11% for 2018 on recession fears in that fourth quarter. 2019 was a great year with low inflation numbers, 19%, with relatively low inflation at 2.2%. And then 2020, you've got your pandemic quarter here, down nearly 14%, but the pension fund recovered during that period, up 11.5% for the year. Very tame inflation, of course, because the economy was shut down for 6 months. Then you flash forward a year, and $6 or $8 trillion worth of off-budget relief money going into the economy, and supply chain issues in 2020 with China, Shanghai in particular, when China shut down their ports. And then you begin to see this inflation number creep up at 6.91 off of an 11% return for 2021, yields the actuary a 4% rate of return. Negative 14.76% in 2022. 6.47% inflation, negative 20%. But you can see here in the flows that during the third quarter, between the second and the third quarter, there was the pension obligation bond. Now that pension obligation bond was $46 million, but if you take the money that also went out of the fund during that quarter, it brings that number down to $44.576 million. So that's the point at which we were investing. We invested all of the pension obligation money during that quarter, and the market literally turned around the following quarter and has just barely looked back ever since. You can see the flows are quite a bit bigger now, that front loading of the bond, 13.79% for 23. As you recall, the CPI had dropped from 6.9% down to 3.3. So the real return to the actuary was 10%. So far this year, I mean, I've got the year to date just momentarily, but you're just under 5% for the first half of the year. And given the performance since the end of the quarter, you're probably up another percent, perhaps two. So basically from $43 million to $96.5 million, there have been net inflows of $19.6 million over that 13 and a half years. Your return has been 4.71% over that entire period. CPI has been 2.66%. I'm sorry, 13.5 years. 4.7%, 2.6 on inflation, with a net unit value growth of just under 2%. Prior to 2022, these numbers were quite a bit different, particularly given the inflation number and the unit value growth on a real basis. But that 2022 with this negative 14, this negative 20 right here was a real torpedo in the side of that long-term performance numbers, those long-term performance numbers. But we'll get it back. The portfolio looks very, very good. Balanced portfolio, this is the executive summary at the top. So your 5-year return is a little over 6%. 1-year returns a little over 1%. And the 1-year return, so that would be from June 30 of 23 through June 30 of 24, up a little over 10%. Looking at the individual managers, your large growth at 22. The reason why you see this 90th here for Loomis Sales on the short term is because you've had such a concentrated run of technology companies in the large growth space over the Magnificent Seven, as I'm sure you've heard about on the news. And this is a diversified large cap growth fund that does not put all of its eggs in the technology basket. Therefore, over the short period, they look a little out of favor, but that's simply a function of the irrational exuberance, you might say, over just a handful of stocks in the stock market currently. Vanguard Equity Income, you might recall that they had really struggled as interest rates rose, but are doing great, top third. ClearBridge is a pretty new addition to the portfolio, 4th, 61st, and 23rd. Fidelity low price stock replaced, I believe, Diamond Hill, if I'm not mistaken, 6th, 19th, and 6th. Hood River, 8th. MFS, 49th, 73rd, and 76th. So small values, a space where it's getting a little, they're certainly on a watch list, I would say. MFS International is a relatively new addition to the portfolio. Fidelity Emerging Markets, 12th. BlackRock, 20th. They never seem to fall out of favor, those guys. MetWest Floating Rate, 5th, 25th, and 8th. So to give you some idea of how that floating rate has performed, that floating rate is up 11% for the trailing 1-year period for a bond fund that's 100% liquid, and its current yield is 8.73%. So not only has it appreciated handsomely for fixed income, it's also performing great vis-a-vis yield. Pardon me. I needed a little fuel. All right. Next page, Vanguard Large Cap Index Fund. You see these peer groupings for 5, 3, and 1 for this page as well. 42nd, 28th, 85th. I know I've spoken about this ad nauseum, but these index funds get really clobbered when the market sells off, and that 85th is what you're seeing from 2022. But you can see here they're normalizing, which is what we knew they would happen. It was just a matter of time. Same thing with the Russell 2000 as well, that 89th. The REIT, 9th, 47th for Guggenheim, 31st for PGIM, JP Morgan, 3rd, 2nd, and 15th. Millennium, 3rd, 4th, and 5th. Blackstone, these are returns for your real estate debt fund. Cohesive Capital, PIMCO Bravo, and then the student housing. Now, the allocations to these four residual investments from Morgan Stanley are very, very small. And however, every little bit counts, and we also want to discuss these with you as well. Let me see if I can blow this up just a touch. All right. This would be the Longview total fund versus its custom benchmark. The custom benchmark is a hypothetical portfolio that mimics the Longview portfolio by way of its index weightings. And you have about 73 basis points worth of cost, investment related cost, investment managers, us, and the like for the total fund. So that total fund number is a net number, and the custom benchmark is a gross number. So when you compare the two, just keep that in mind. So 4.26%, 508. So because of the adjustment for the fees, that's effectively right on top of the benchmark. 649 over a 559, clearly outperforming for the last 7 years on an average basis. 604 versus 564, 11 versus 97 basis points, 107 versus a 1008, and then 464 over a 385. So y'all have had basically some significant outperformance over your custom benchmark for quite a few years. And then the Longview total fund. And of course, we don't give a whole lot of, put too much stock in the year-to-date stuff, but nevertheless, the long-term 10 years where we were still doing some surgery on the portfolio. I'm sorry, we weren't, no, 10 years ago, but it was loaded up with alternatives as well.
Right. Yep.
So the custom benchmark, what I was going to mention is the custom benchmark that we use, this is not a great apples to apples comparison, because the portfolio was so very different 10 years ago. So 7 years ago, 30th to 54th, 43rd to 52nd, 61st, 63rd, 55th, 56th, and then 54th versus a 73rd peer grouping ranking on the return rank. So, Mr. Chairman, we're not recommending any changes for this. Let me stop sharing here. We're not recommending any changes at this time for the portfolio. The next addition to the portfolio or allocation change will probably come in the spring, and it will probably consist of perhaps some fixed income changes predicated on where interest rates are at that time, and potentially some additional alternative investments, but those will come with a great deal of due diligence, and that might take a little more time, obviously, because of the care that needs to be taken during those types of searches.
Thank you, sir. Is there any questions for Will or Charles? No? Will, I just have 2 questions. Looking at the iShares mid-cap ETF on our mid-core and the Vanguard Russell 2000 ETF, the small core, I know you said the ranking had a lot to do with 2000 or 22 rather. At what point do we consider swapping from passive to active in those categories, or you think this is something that'll smooth out with a little more time?
Yeah, I believe that's already, that bomb has already gone off.
Yeah, it's in the process of doing
It's in the process of a full recovery.
All right. And then I think, and I tried to go back to my notes and I didn't see it, that MFS New Discovery Fund that we talked about watching, I think that might have been something we were watching as of last meeting too. At what point do we possibly need to consider pulling that trigger? Or?
We're in the preliminary stages of not only a small cap value search, but also a large cap value search. And I will tell you that because of where interest rates are, it is a very tricky search. And so we're in the process of working on it. But because of where interest rates are and dividend yields, it is something that it's one of those things that can change very quickly. And you can wake up one morning and that small cap value and that large cap value, those allocations look great. Well, as you can recall, the Vanguard Equity Income was on its back just a couple of quarters ago and has completely recovered. So during these higher interest rate times, the value funds are a little trickier, but we are very much aware of it and are researching the issue.
Okay. If no other questions, I appreciate your time, Will. I hope you all have a good meeting in Galveston today. Good to see you, Charles, and y'all have safe travels home.
Yes, sir. Thank you.
All right. Because we have our CPA on the board that is going to have to leave shortly, if it's all right with everyone, I'm going to go ahead and skip down to the presentation of the year-end audit from Henry and Peters. Next action item, or presentation C.
Yes, can y'all hear? Can y'all hear me through this?
Yes, sir.
Okay. Yeah, so first of all, thank y'all for letting us perform this service for your fund. I think this is now 3 years going on, so it's been a good relationship, and we appreciate your help and diligence with everything. There's going to be 2 items that I'll go over to begin with. I'm going to start with what's called our communication with governance letter. So this is required at the conclusion of every audit. There's some pieces of the audit report that we feel are significant to the users of the financial statements, and so it's one that we always try to bring up to management and the board and governance. So a couple of those things, we would talk about if there's any kind of new accounting policies that had to be adopted with new standards that come out. Luckily, we were in 2023, at least on the benefit plan side, there was not any that needed to be adopted. We also bring up what we consider to be the most significant estimate to the financial statements, which are the fair value of your investments. Kind of like they were discussing, investments are subject to significant fluctuation from day to day, from month to month. So, and we're looking at these financial statements, and we're almost a full 8 months away from the balance sheet date. And so, as you heard from them, the fair value of the investments has gone up, which is a great thing, but it's definitely one of significance to the users of the financial statements. There's also some required disclosures that we feel are very important. Those are actually in Note 5 to our audit report, and it deals with a lot of the net pension liability and a lot of the estimates used by the actuaries when they're trying to look at projections down the road for future benefit obligations. So Note 5 does come from the actuaries. It's of great significance to the report and to the fund's health overall, so that's something to always warrant your attention. This is also the time we'd use to discuss if there was any disagreements with management during the testing, which we're happy to report there were none. And then we also discuss with management and obtain certain representations from them as far as their responsibilities in regard to the financial statements. Outside of that, we'll move into the actual audit opinion, which if you have a bound report with you, it's on page 3 is where that begins. And so luckily, a couple years ago, they moved the opinion piece to the very top of this letter, so you're not having to dive through the required legal language that we must put in there. So at the top, I'm happy to report it was a clean opinion. We do feel like the financial statements themselves are materially correct in regard to the values that are on the balance sheet and the income statement. And this opinion letter will also, down towards the bottom of the first page, will give you a little bit of transparency between the auditor and the management's responsibilities. It just gives you a high overview of the audit process, as well as on the second page of the opinion letter, which is page 4 of your report, you'll look and see what the required supplemental schedules are in that other matters paragraph. So these are required by the fund because it is a defined benefit plan. So you're kind of looking to pay, future benefit obligations. So there's some schedules and some estimates that go into that. And so all those schedules are at the back of this report. Moving past that, you move into the management's discussion and analysis section, and this is an unaudited section. This just kind of gives you a high-level overview of the plan itself, what makes up the footnotes, and what some of those required supplementary schedules are. So you'll see that. You'll see that the basic financial statements are in here. It brings a note-by-note description of what each footnote in the tables look like, so you can have all that information. And then the next page, on page 7, gives you an overview of the plan from plan membership as well as the high-level financial data. And so I'll talk on more of those when we move right now to the financial statements themselves, which are 2 pages down on page 9. So this gives you it's called the Statement of Fiduciary Net Position. It's your balance sheet. So it's a snapshot in time, which our year-end date is 12/31/2023 for this reporting period. So this gives you a snapshot of all assets and any type of liabilities, if there are any, that are required of the plan as of 12/31 to be in accordance with GAAP. So here, the big change obviously is what we talked about with investments. That is your balance sheet. That's essentially you're accumulating assets in order to pay future benefit obligations. And so we've seen from the 2022 column year, we've seen significant growth in the fair value of investments. A little bit of that is contributions into the plan as a result of net income, along with some unrealized and realized gains that have occurred during the 2023 year. So you'll see up about $7.6 million. Great growth, especially coming in from 2023 or 2022, where stuff kind of bottomed out a little bit towards the end with everybody. So we kind of saw that across the board, and 2023 has been an overall pretty healthy year for a lot of these funds. And so overall, you've seen growth go up to about a little over $93 million as of 12/31/2023. On the next page, on page 10, which, sorry, I'm not even paying attention to these. On the next page, on page 10, so this is your income statement or your statement of changes in fiduciary net position. And so we'll start with kind of contributions, which, if you remember being into this plan last year, was the pension obligation bonds that were helped to help fund and kind of reduce the unfunded liability. And so you saw, obviously significant employer contributions for 2022. And then you've also seen, I think, as part of those pension obligation bonds, a reduction in the employer percentage. And so overall, even for the 2023 year, between contributions coming into the plan and the return of investment income, you've seen a great growth of about $16 million, and that's obviously before any deductions are paid out. And so moving into that, deductions were pretty consistent with the prior year, about 8.6 in the prior year to 8.7 this year. That's going to be subject to fluctuation based on if there's, terminations or retirees with drop payments. So that number kind of stayed the same, which is always good to see. So you can kind of be consistent and kind of look forward to what's going to help us as far as contributions to fund the plan. So consistency is always a great thing in that area. Some of the notes to the financial statements, and they're real high level. Some of the stuff I wanted to hit on is note 2 on page 13. It's a new lease standard. We actually did not end up adopting it because it's just not significant to the financial statements. It's not considered material. It is a new lease standard that would require you to capitalize lease assets onto your balance sheet along with liabilities if they are material and longer than a 12-month period. Luckily with the fund, we don't have that situation, but it's just something to warrant because there's a paragraph in there. Note 3 talks about your contributions, which we've kind of already hit on. 2022 had the large contribution into it for the pension obligation bonds. Note 4 on page 14 details out all of your investments. And so a lot of this information is recurring. And so you'll see from note 50 or page 15, we have a fair value table that associates the different assets held. The PRB does have certain requirements for submission of this report, which on page 16, you'll see that with the investment and the investment managers. Details out a breakdown that's required to be submitted. And then also another one of their new requirements, which this is the second or third year of, on page 17, we're required to show fees paid directly by the plan that you can see coming out of fund statements, along with any kind of fees that are netted from your returns. So in a situation where a fund is paying out a dividend of $50,000, if there's a $5,000 management fee in there, the fund's receiving $45,000. So we're required to disclose exactly that there's an additional $5,000 that was paid, even though the fund itself is not cutting a check to the investment. So that's kind of what those two columns show you. The first column will show you the funds actually paid directly from the plan, and then the second column shows them netted as well. Note 5, like we talked about, I will defer all those questions to the actuaries who are a lot more qualified to discuss these. But as far as pension liability, inflation, and other type of statistics that go into their calculation when they're forward looking, And then outside of that, really, it's just the required supplementary schedules that are at the back. A lot of these footnotes stay the same, but if you'll look, if you get to page 2022, it starts our required supplementary schedules. So these are required to be for the PRB and as well, since it's a defined benefit plan. 22 and 23 and 24 pages are pretty consistent. We did move one table to the back for page 25 that gives you a breakdown of investment and administrative expenses for the fund. That's a PRB requirement now. And so we've kind of moved that to the back. But it shows you a breakdown of what exactly makes up the investment expenses and the administrative expenses that are on your statement of changes in fiduciary net position. And then that is all of your required schedules. You have any questions? I know that was a lot and that was quick.
Any questions for Tyler?
No.
No? Tyler, thank you very much for your presentation.
Yeah, thank you all for having us.
Next up, we'll ask Ms. Redmond from Foster & Foster with the presentation of the 2023 Actuarial Valuation.
Okay, good morning, everyone. So just a couple of general comments before going through this presentation. So there were no assumption changes or benefit changes to reflect since the previous valuation. And then the other thing I wanted to point out is that we are still using a 3-year smoothing method to value the assets. And so as you'll see, even though we had a very great year for 2023, we're still showing only a slight increase in the assets that are valued in our report, but that's just due to that smoothing method, which I'll get more into those calculations on a later slide. But first, looking at the liabilities. So in total, compared to the previous valuation, we did see an increase in the total accrued liabilities of about $7.9 million. And looking at the actuarial value, you can see that it increased slightly just above $200,000 from $94.2 million from the previous year to $94.4 million as of 12/31/2023. So in total, this does increase the unfunded accrued liability since the previous year. You can see last year that the unfunded liability was $31.7 million, and now we're sitting at an unfunded liability of $39.4 million. Most of this, as I mentioned, is due to the smooth actuarial value of assets, and that only increasing a little over $200,000 since the previous year. But the other primary source of loss was on the liability side. We did see larger than expected salary increases based on our salary increase assumption that we use to determine the liabilities. So all in all, the normal cost rate, which this is just the dollar normal cost, which the normal cost is just the cost of the benefits that are going to accrue throughout the year. So that normal cost rate is the dollar normal cost as a percentage of the covered payroll. So we do see that increase by 23 basis points from the previous year. Most of this is probably due to the fact that, Tier 1 members, as they retired, they're being replaced by Tier 2 members in which the cost of their benefits isn't as much to the plan. Next, looking at the funded percentage and the amortization period. Based on those two primary sources of loss, we do see the funded percentage decrease by about 4.3%. And so right now we're sitting at a funded percentage of 70.5% compared to 74.8% from the previous year. And then the amortization period, last year we were sitting at 27.6 years, and now it's increased 4.4 years up to 32. However, as I mentioned, we're reflecting that 3-year smoothing method, and so we're still kind of feeling those effects from the 2022 market performance. However, if you look at it from a market value basis, The funded ratio did increase from 68% from the previous valuation, and on a market value basis, as of the 12/31/2023 valuation date, where we've increased the funded ratio by 1.7%. And then looking at it from an amortization period standpoint, last year, the amortization period would have been 39.1 years. And then this year, on a market value basis, the amortization period would have been 33.4 years. So you do see about a 6-year improvement from looking at it from a market value standpoint. Okay, so next, looking at contribution rates. Right now, the city is still contributing 12% of payroll. Previously, this was at 19%, but due to the pension obligation bond, it will not increase back up to 19% of payroll until that bond matures in July of 2047. It was a 25-year pension obligation bond. Next, the members are contributing, depending on which tier they're in, either 15% of payroll or 17% of payroll. And next, looking at the actuarially determined contribution. So as of last year, we were, the ADC was 12.95% of payroll, which was a shortfall of right under 1%. Now, based on the two primary sources of loss and overall having net unfavorable experience, that does increase to a shortfall of 2.86%. And if you look at the table that shows all of the bases, you can see that for 2023, there was about a $7.4 million base that was added into these calculations. And amortizing that over 30 years, we now have an amortization payment of about $2.4 million, which as a percentage of covered payroll, it comes out to that 14.86% of payroll, which, as I mentioned, was a shortfall of the 2.86% compared to the city contribution rate of 12. So next, looking at the market value of assets, I don't want to get too involved in going over this, but as you can see at the beginning of 2023, the market value of assets was basically right at $85.6 million. We did have about $4.7 million in contributions coming into the fund, $12.3 million of total investment income coming in from dividends, interest, and realized and unrealized gains and losses. And so then in total, the deductions were $9.3 million. And so at the end of the year, the market value was $93.25 million, which was an increase of about $7.6 million compared to the beginning of the year. And so for 2023, the estimated rate of return was about 13.88%, and this is compared to negative 11.75%. That was the estimated rate of return for 2022. And finally, looking at the actuarial value of assets, as I mentioned previously, that the fund utilizes a 3-year smoothing method. And so as I had mentioned previously, the market value of assets beginning of year was $85.6 million. Based on the net cash flow and expected return using the 7.5% assumption, we would have expected the market value to be right around $87.9 million. However, as we saw on the previous slide, the market value was actually $93.2 million. So we do have a gain for the year of about $5.334 million. And so on line 7, you can see that this is how the actuarial value of assets is determined based on deferring gains and losses. And so since it's a 3-year smoothing method, the 2023 gain or loss, so in this case it's a gain, 2/3 of that gain is not yet recognized in the actuarial value of assets. And then that loss from 2022, only 1/3 of that is now not recognized in the smooth actuarial value compared to last year. If you look in the right column, 2/3 of that value, or 2/3 of that loss was not yet recognized, which was about $9.4 million. And so right now, comparing this year's to last year's, This year, the deferred loss is only about 1.15 million compared to the deferred loss last year, which was right at 8.6 million. And so for 2023, we have the resulting actuarial value of assets being 94.4 million. And so based on the smoothing method, the estimated rate of return was about 4.53% compared to that 7.5 assumption. And so finally, as I had mentioned previously, there were no assumption changes or benefit changes to reflect. However, the last experience study that we did perform was done in 2019, and so it is recommended that a experience study is done every 5 years just to make sure that actual plan experience is aligning with our assumptions. And so for the 12/31/2024 actuarial valuation, we would like to perform another experience study just because the last one was done about 5 years ago. And it would probably cover the 10 years of plan experience from January 1, 2014 to December 31st, 2023. And then finally, the last couple of pages on this presentation is really just going over required disclosures, discussing the data, assumptions, methods, and plan provisions we used, any discussions of risks, and then other information about the use, scope, and qualifications. So are there any questions?
And I know we covered this in some email exchanges, but just for the audience listening, the actives that count, I know sometimes those numbers don't necessarily match up with the audit, and those numbers are pulled from two different sources. Could you just briefly explain that? So if someone were to come behind and say, well, why does this report say this many actives and this one mainly for just...
Oh, okay.
Yeah.
Okay. So if you were to look at our valuation report as of 12/31/2023, so this reflects the actual number of actives, the actual number of retirees in the plan as of 12/31/2023. If you're looking at the GASB report, the GASB method is a roll forward, and so really it obviously is using the actual assets as of 12/31/2023, but on the liability side, it is looking at the previous year's participants and all of those liabilities and rolling it forward up until the current valuation date. So it's really using the participation or the participant count as of 12/31/2022 and all of those liabilities, but rolling it forward for GASB purposes up to the 12/31/2023 valuation date.
So if you had to summarize, this will probably be the biggest question that we're going to hear, the biggest factors that, and I think you covered the smoothing, which I guess comparing the GASB statement to the actuarial study would be a good, this is what you did on a market value versus an actuarial smooth report. What were the biggest contributing factors to the negative movement of the amortization period?
So as I had mentioned, the two primary sources of loss were the salary increases. And so, and this is something like I had mentioned to you previously, was that, this is something we've seen, industry-wide, is that we've seen pretty significantly higher salary increases than what was expected. And so if you look at the report, there was, I think it was over $4 million where there was a loss on the liability side, and a good portion of that is due to those higher salary increases. And then from the asset standpoint, as I mentioned, the actuarial value only increased $200,000. And so, but if you look at the market value, we see, over a $7 million gain or increase from the previous year. And so really those are the two main contributing factors. But as I had mentioned, if you look at it from just looking at it market value, if there were no smoothing, if there was not smoothing to determine that actuarial value, we would have seen an improvement on the amortization period from 39.1 from the previous year down to 33.4. And so as Will was saying, as of now, the assets are now over 100 million. And so obviously there's still, 4 months left of the year, anything can happen. But compared to at the beginning of year, the market value of 93 million, as long as, there's not any unfavorable experience in the stock market throughout the year, we should see, the 2 year, or 2 years having both gains, we should see a better result in the actuarial value of assets for the next valuation.
And would I be correct in stating that the salary increase, if, I know we had 10 less active personnel in this study than the previous year. If those spots, if we just nearly obtained full staffing, if we were able to maintain that staffing level and having, I guess, 10 more people to divide that salary amongst, would that be a positive or negative, or would it make a difference in the results?
So, obviously it would increase the liabilities and have a higher normal cost. Whenever you look at it as a percentage of payroll, it really just depends. The good thing though is about, with more participants and more actives in the fund, of course, as I mentioned, you have a higher liability, but you also have higher payroll. And so that does mean more contributions as a dollar amount coming into the fund. And so we've seen where, there were significant salary increases. The city, is contributing a larger amount, but because of those insane salary increases, we actually did see a positive impact on that amortization period, just because whenever we determine the amortization period, we start out with that covered payroll and then increase it 3% every year using the payroll growth assumption. And so while on the liability side, we would see an increase in the liabilities and an increase in the normal cost as a dollar amount, we would also have more contributions as a dollar amount coming into the fund. So it really just depends on which comes more into play.
Any questions for Lindsay?
So the PRB's recommendation or suggestion, what we have got to follow is 30 years, is that right? Or is it?
That is correct.
And is that based off of what timeline does that need to be? So we're at 32 right now.
Right.
And so what timeline does that need to be under the 30-year?
Right. So I know, 9/1/2025 is whenever they're being more strict on the criteria to trigger an FSRP, and so right now it's at 32.0 years, and the PRB had actually reached out to us and Brad specifically asking, was it 31.9 and it was, rounded up to 32 exactly, or was it 32.04 and it rounds down to 30? And so whenever looking back at the calculations, it was, exactly, 31.97. And so, sorry, Colby, your email from a week or so ago regarding, the PRB saying that the city, what would it take to get to a 31.6-year amortization period, just so, once that time comes around, as of 9/1/2025, we would be at 30, and, there would be no FSRP requirements. But from what I'm understanding with Brad's conversation with the PRB actuary is that as long as we were under 32 years, it was going to be there wouldn't have been any kind of pushback on more money coming into the fund. So, as I mentioned, as long as we really don't see a huge loss on the liabilities as we did in the previous year, and assuming, that we still finish strong throughout the year on the asset side, we really should be in much better shape than what this shows. We're just still feeling those effects from the large loss on assets in 2022.
And that was the second thing that was contributing to it, was the big loss
Right.
on
So
2022.
the market value increased 7.6 million, but because such a large loss from last year was deferred, we were having a $7.6 million difference in the market value versus the actuarial value. But now, because only 1/3 of that loss from 2022 is now being reflected, and then the 2/3 of this year's gain, there's a much closer gap between that market value and the actuarial value. So when you look at it from a market value standpoint, we had really good results in terms of assets. It's just not being reflected yet in that actuarial value just because of the smoothing.
And that's also the impact of inflation isn't taking into effect of that too, in those calculations?
You said inflation?
Yeah, does that also, are we looking at the real return on the investments?
I mean, the estimated for 2023, that market value 13.88. I mean, that is including inflation.
Okay.
And then same with the actuarial estimated rate of return of 4.53. That is including inflation as well.
Okay. And then, what is, like, is 3-year smoothing, is that typical? Is that what we use?
That is what you use. Typically, on the public sector side, normally it is smoothed over 5 years to where, the 2023 year gain, it wouldn't be 2/3 deferred, it would be 80% deferred. And so each year an additional 20% is recognized. But 3-year smoothing is probably less common, and you'll see more volatility, I guess, but it's still less volatility than if you were to just value it as fair market value of assets.
What is PRB? Do they give any guidance on what we should be using?
I mean, for purposes of, this is a fixed rate plan, so really what's helpful for, if you use an actuarial value, is for plans who fund based on an actuarially determined contribution. It basically smooths out their contribution requirements year over year. For fixed rate plans, it's kind of, I know for purposes of, determining amortization period and FSRP requirements, the PRB will look at both an amortization period based on actuarial value and market value. So as long as one of those, meets their criteria, they're good. But like I mentioned, the smoothing method does, whenever plans are funding on a actuarially determined contribution standpoint, it does smooth out their required contribution, so there's not so much volatility. But for purposes of a fixed rate plan, it's always good to look at it both at a market value standpoint as well as, the market value, just so you can see the true, like where the fund truly stands as of a certain valuation date. But I don't think they would favor one or the other. It's just for purposes of, like we saw in 2022, that significant asset loss, it helps smooth those, that loss out over a 2-year period or a 3-year period or a 5-year period.
And because, it's pretty volatile. You're talking about a 4.5% difference in amortization period just over the course of the 3 year.
Right, but most of that was, if you look at the report, I'm not sure what page it's on, but if you look at the detailed gain loss analysis in the actual valuation report, it shows about a little over $2 million was due to the actuarial value of asset loss, but most of that is due to the larger than expected salary increases. It was over, on the liability side, the loss was over $4 million.
Yeah. That's what carried over to us this year, a $4.7 million loss. So, John, I can explain what Mr. Fee from the PRB, their actuary, explained to me about the 31.6. When we did meet the goal of the FSRP, they basically provided us a chart and said, we realized that, investments aren't a straight line, so they kind of gave us rails, high and low. And the upper rail was actually 31.6 years. And when we crossed that, according to the PRB standard, because we do annual valuations, if we were to have 3 annual valuations in a row that are outside of those guardrails, it would re-trigger an FSRP, a revised FSRP. This would be year 1. His comment to me was the difference between 32 years amortization period and 31.6 might not be that much money. And if there was a desire to put a contribution rate on to basically eliminate this year as counting as one of those 3 years, that was, I think, the intent of figuring out what dollar, was it $100,000 or $700,000, you know, what that line would have done to make this year not count as one of our 3 years. Now, fortunately, knock on wood, as long as the market stays, I believe all of 2022 will be recognized by next report.
That's
and we
correct.
will carry no negative forward from that, and we'll carry forward the remainder of the gain of 23.
That's correct. And I mean, obviously, if there's 2 gains, you know, the 2023 gain and a 2024 gain, the market value is actually going to be higher than the actuarial value. But, I mean, where we're at now, on a market value standpoint, is 33.4 years. And last year, it was 39.1. And so with a 13 point some odd % market value rate of return, you know, if we see similar results for this year, you would probably see that on a market value basis, go under that 30-year threshold. But I mean, for purposes of getting to a 31.6 amortization period, that would be about a $300,000 to a $350,000 lump sum contribution into the fund, and that was determined putting that money into the fund as of the end of the year.
So you're saying there's a 3-year so 3-year look on the
3-year consecutive
time period on that.
That would do that.
with the 3-year smoothing in addition to that. Okay.
Yeah.
And then how does the effects of like on pay we're talking about? How does the effects of overtime? Does that have anything to do with it?
Well, so I believe overtime really accounted for the majority of the salary increase. It's not a pay raise necessarily that caused that. It was the overtime.
Time.
And that's where, if you reduce the overtime by fully staffing and spread that more equally, even though you would have an increase of liabilities from the 10 extra, or the 10 employees that bring us to full, it would decrease the average salary of people that were having overtime in their salary. So it's kind of a positive negative, but I think it ends up winning in the balance.
I would say so. I mean, obviously, you know, if you know, we get the 2023 pay information, and then for purposes of figuring out, okay, well, what are they going to be paid in 2024, we do apply the salary increase assumption. So if someone knew, you know, let's say that it's their 2nd year where based on our salary increase assumptions, they're still getting, you know, a much higher salary increase, like 8%. I forget what the exact rates are, but normally, you know, if you look at any salary increase assumption table, you know, newer hires that are early on in their career get higher salary increases, whereas, you know, people who are long in their career, they, you know, it's normally 3-4%. And so, you know, if someone who was, you know, a 2-year, they have service of 2 years and they have a higher, because they were working all this overtime, well, our software takes that number or increases it with 8%, and then every year it's going to increase more and more by whatever our salary increase assumption is. And so now they're being projected to have a much higher benefit when they retire than they previously would. And so that's why you're seeing so much of a loss and an increase in the accrued liabilities, is just because, I guess, of obviously the salary increases, but also firefighters who would have taken a lot of overtime hours.
Okay, so the salary increases was due to some of the overtime and stuff like that. I wasn't sure if it was due to the COLA increases that we did prior year was causing that. Okay, so it's from that. All right, and then what is the actuarial experience study difference that you recommended on the 5 years?
So really what, I mean, for purposes of an experience study, what we would do is just take the plan experience over the last 10 years, look to see how it compares to what our assumptions are, and then make any adjustments necessary. So, I mean, obviously if, I mean, this is a large increase in salary compared to, you know, what we've seen in the past. And so, you know, for purposes of us proposing new assumptions, we would probably take that into account and say, okay, well, maybe we look at, you know, the full 10-year period, but maybe look at the last, or, you know, the first 8 years or 9 years of that 10-year period, just so we aren't, you know, reflecting that unusual amount of overtime and those salary increases that, you know, aren't going to typically be happening year over year.
So it's a 10-year look back based on looking at our wages, investment return.
Wages, investment return, the retirement rates, termination rates, salary increases, disability rates.
And then before our last study that we did, were we consistent on 5 years, or how long ago was before the other one? Do you know?
So the last experience study was done in 2019, and
The one
it
before.
was
2016 was,
Okay, so we've been consistent on the 5 year.
yeah.
Okay.
I can pull the 16 up, and I can't find the 19 to save my life. But I could see where in the 16, we made some adjustments, and I was just curious where they ended up on the 19. Like our termination rate, we actually fell short, and I think we had projected a 4% termination rate. I'm sorry, we had a 4% termination rate, and we were expecting a 4.5. So we moved it to 3.9%, which added 7.8 years of amortization period to the table. And I know we've been averaging about 14 for the last 3 years, termination rate non-retirement. So just, I guess, the dynamics have changed in the 8 years since that study was done. But I don't know what we did in 2019. I'll have to dig deeper for that report and see. I know we've made some adjustments to those. So oftentimes the experience study comes with, you know, gains and losses. I know in 16 we took a pretty big loss. I think that's when the mortality table changed and
Right,
added
and-
like 2%.
Yep, and then I mean, right now we're sitting at a 7.5% investment return. I'm assuming at one point y'all are probably, you know, at 8%. And then also, you know, a higher payroll growth assumption. So for purposes of determining an amortization period, those are the two biggest factors. Just because, you know, for payroll growth, we start with the covered payroll amount and then increase it by what previously, you know, was 4% or 3.5%, and now it's 3%. And so then, you know, we have less money coming into the fund, which then, you know, extends out the amortization period. And so now, you know, that we're at reasonable assumptions, I wouldn't say, you know, if, you know, an experience study was to be done, I don't think unless we see any drastic changes compared to, you know, experience versus looking at what we expected, there shouldn't be any really drastic assumption changes that would move the needle that much.
And when do we normally do this experience study? Would we do it at the end of 2024?
Honestly, I mean, as long as it would be done before we complete the 12/31/2024 valuation, it really just depends on what y'all's timing needs are. We can either do it, you know, get it done by the end of this year, or, you know, it still be on the table, but postpone it until January, February, or March of next year. It really just depends on the timing needs for you guys.
Well, I think 2024 has been, like, hopefully the market stays up.
Yeah.
And then it doesn't seem like there's going to be pay raises this year.
It's actually on our action items to approve a study
Okay, it is on.
in the meeting today
Awesome.
to keep with the 5-year.
Oh, it's on there? I didn't pay attention.
Yeah.
Okay, well, thank you then. That saves me those questions.
Um,
All right.
All right. Last question. Mortality, any changes? Like, I know any drastic changes?
Nope. I mean, obviously the public safety mortality tables is still what we're using. The Society of Actuaries, their retirement planning committee still has not produced and put out a new mortality improvement scale. This was basically put on hold whenever the pandemic occurred, and they didn't want COVID experience to basically shift what their mortality improvements or would be. And so we are still using the MP 2021 table, and I'm not sure whether or not they plan to put out a new table for at the end of this year. Normally they do tend to release them towards the end of a year, but ever since the MP 2021 table, they haven't put out a new mortality improvement scale. So when it comes to the experience study, we really wouldn't recommend any changes to mortality table.
Any other questions?
So taking into account the differences in non-vested terminations and some of those things that we're kind of expecting to see in the experience study, changes in staffing, filling empty seats that will change those salary increases.
Mm-hmm.
Would you expect that, based on your opinion, to reduce us back down below that 30-year amortization period? Just with some of those normal corrections.
Right. I mean, what you're saying that, the non-retirement terminations, so you're talking about like early in their career, 0, 1, 2, 3, 4 years or service or less. I mean, normally we recently did another experience study at the beginning of this year. And the last time we had performed an experience study for them was 5-ish or so years ago, and we saw a very significant increase in those termination rates as well for them. And so, I mean, even making those changes, I mean, it does impact the accrued liability sum, just because you'd be, we value their refund of contributions, and so, 16% or 15% of payroll or 17% of payroll, it does increase the liability sum. But I think the overall, it would increase the termination decrement liabilities, but overall for retirement, I think the net would be, you would see a decrease in the overall liabilities.
Right.
And then therefore in the amortization period as well.
I don't know if it would be possible, but I think it would be an interesting way to look at the study if there was a way to look at it as payroll totaled instead of individuals, because I think that number is going to stay really, really similar, because ultimately we fill the seats regardless. So whether it's a fireman working overtime or a fireman actually being a low-tiered fireman filling that seat and actually being employed, I would be interested to see it. The number is a very static number here, so I wonder if we could plug that number in and use it as an overall salary number or a payroll number.
Right, and that is another assumption that we look at as well for payroll growth. We look at, over the last 10 or so years, we look at what the total payroll growth has been year over year. And so the assumption right now is 3%. And I'm not sure what it was in previous years' valuations before the 2019 experience study. But generally, like 3% is normally the assumption that we recommend, especially, for somewhat larger TILFR plans. But that is something that we look at, is just overall what has been the average increase in payroll in total over 10 years, over 5 years. And we do that analyzing to determine whether, the 3% is reasonable, which it really should be, or, if any adjustments are needed to decrease it even lower, or even, I guess, increase it. But the 3%, which is what y'all are using now, is pretty reasonable based on it should be reasonable based on historical data and just what other local plans use for that assumption as well.
So are salary increases and payroll growth the same?
No. So salary increases is looking at it individually. like every individual person, and, over the 10-year period, they're gonna fall, their first year, they're gonna be 0 years of service, of past service, and then the next year, they're gonna fall into that 1-year service, and so on and so forth. And so whenever we look at, the individual salary increases, that's how we determine what the salary increase assumption is. But for purposes of total payroll growth, obviously that, accounts for salary increases, but it also accounts for, if someone who's, later on in their career, they're gonna, terminate and then get replaced by, or retire, and they're gonna be replaced by a newer hire. So really what the payroll growth assumption is saying is just in general, how much is that covered payroll growth gonna increase year over year over year? Whereas the salary increase assumption is like, okay, this person's being hired at the beginning of the year. What is their projected salary going to be at retirement? And so then in those earlier years, we typically will see much larger salary increases. And then, once they get mid-career, later on in their career, is when we start to see those lower salary increases. And so really, salary increases looking at it individually, and then the payroll growth assumption looks at the total active population collectively.
Now, y'all get like, it's 15 years on the pay scale? Like,
It's broken down per position.
per position, is it
Yes, sir.
15? How does it work?
Our firefighters go all the way up to 19, but all the other ranks stop at 9.
Is that considered there, or is it just based off just averages?
Just percentages.
Percentages.
based off of age.
Yeah, I mean, it may be helpful if, we receive, some kind of data from y'all about, where current salary are for different rankings or different, years of service. But I mean, whenever we look at, actual versus expected experience, we're just looking at, what a certain firefighter has made year over year. We're not sure of how much of that is overtime, how much of that is, actual increase in base pay.
Okay.
When y'all run that study, do you run every individual in the fire department, or is it do you?
Yes,
Sample.
it's every individual.
So you say, because if you pick the wrong couple of guys.
Yeah,
that could look
no,
really bad.
every single active is looked at
Okay.
throughout the 10-year period, or 5-year, so.
Any other questions? Lindsay, thank you so much for your
Yes, thank
presentation.
Thank y'all.
All right. Moving on to our action items. Action item A is review and motion regarding the second quarter pension performance as presented by Will Harrell.
Move to approve?
Second.
Have motion and second to approve action item A. Is there any discussion? If not, all in favor say aye.
Aye.
Anyone opposed? Motion carries. Action item B, review and motion regarding recommended trades for second quarter performance presentation.
Was none?
Yeah, we could move to strike that. There were none. Is there a second?
Second.
All right, all in favor say aye.
Aye.
B is strike. Action item C, review and motion accepting the 2023 actuarial evaluation.
Motion to accept.
Second.
Motion second to approve the 2023 actuarial evaluation as presented. Any discussion? If not, all in favor say aye.
Aye.
Anyone opposed? Motion carries. Action item D, review and motion regarding the approval to perform an actuarial experience study.
The only question I have on that is, are we going to stick with 5 years? Are we going to reduce it down?
Well, we're at 5
or-
years now.
Yeah, I'm
So
just saying, like, in the
2019.
future, are we going to look at doing it more often, or to,
Your
Does he look like
recommendation's
the
5
smoothing?
years, right?
I mean, yeah, that's, the normal recommendation is every 5 years. But I mean, every 3 years, I mean, if we saw, significant.
Do you mind going to the microphone?
Sorry.
I just know that, like, you said you had 16 and 19, right? So, because we did one in 16
Yeah,
and
so
another in
16,
19.
that would be 3
So
years.
3-year change, that was the only difference. A
Yeah.
question I had is,
I
if we're going to
think
stick with
19
5, or if she
actually,
suggests.
There was a purpose
I
to
think
do it in
that
19,
was
and I'm
a
trying to
special
remember
study.
why.
I think in
remember why I added, but it was a
2019,
special
maybe,
study.
well, 2019, I think, is whenever we moved from market value to the smoothing.
Okay.
And
I
I
was,
think there were
So that
some
was a
changes
reason.
also.
I think
that
the
took
investment
place when
return.
Yeah, we went from market value to smoothing. We went from 7.75% to 7.5%.
That's right.
And then I think lowering payroll growth was also, but I'm trying to think, I mean, it seems like it wasn't too long ago that the public safety mortality tables were released, but I think I think the mortality tables were actually changed in our 12/31/2018 valuation. It may have been the 12/31/2019. But, I mean, generally, I mean, if we are not seeing any significant changes from expectations and, you know, all of the assumptions, I think 5 years is reasonable. But if we were to continually see year over year that, you know, salary assumptions aren't looking right, or, you know, terminations or retirements or whatever decrement it may be, we would probably either, you know, look directly at just that assumption and change it then, or if we feel like an experience study is necessary, we would obviously bring that up to you guys. But I think, you know, 5 years generally is what's recommended.
Is there any requirement with us now being over the 100 million threshold?
That was gonna be the next question, is what actually changes with
It
that.
may have to be required.
They're in the process. It's out for public feedback at the PRB because of, you know, what if we hit 100 million
many
and then go back
quarters,
to
yeah.
99 and then hit 101 and go back on what it's going to be. But experience study, no, but we'll actually have to start performing actuarial audit, I guess, where we hire another actuary to
Audit.
evaluate your actuarial determinations and give their opinion on that we're being consistent with where it is. And that's the $100 million line. But what's going to set that trigger point is currently up for debate at the PRB, and I think those answers are coming next month of how they're going to figure where that line. I know we were right on that line, so
I think the
we'll have to
3
wait
year,
and see.
the 3 year thing, because 3 years consecutive above that would be like pretty solid.
Yeah.
Kind of sticks with their rails on the amortization deal. So there is nothing, just to clarify, there is nothing in the $100 million deal regarding the actuarial experience study, only the addition possibly of another actuarial audit.
That is correct. I believe there is a recommendation of best practices to perform an experience study every 5 years, but I don't think there's an actual requirement.
Okay.
Yeah.
I mean, I think 5 years, considering it's a 10-year look back, I think doing it more often would be kind of.
I mean, the look back really doesn't have to be 10 years.
Okay.
I think the one that we just recently did, we actually only looked at the last 5. And so really, I think in the first couple of ones we've done, you know, the 10-year look back. But we can certainly probably look at both 5 and 10 year just to see, you know, what, you know, kind of look at, you know, where things are now trending compared to, you know, whenever we're looking at the full 10 years, how, you know, trends have changed through, you know, each of those assumptions that we use.
So do we need to approve how long of the look back now, or is that just
Really,
based
we're
on?
just,
Yeah,
we're
be
just
fair.
approving to perform the study at this point, and then we can
We don't have to determine
decide
date-
in
date or anything
3
like
years,
that?
5 years, our choice when we want to perform the next one.
Make the motion to approve
Well,
action item D.
What about the date? We
Oh,
don't have
sorry.
to determine that right now either, like when we're gonna. okay.
We'll give her the
Yeah,
green
yeah, we can
light
talk
to-
logistics later, yeah.
Okay, awesome. Larry, go ahead, JR.
Make the motion to approve action item D, actuarial experience study.
Second.
Any more discussion? If not, all in favor say aye.
Aye.
Aye. Anyone opposed? Motion carries. Review and motion accepting the 2023 financial audit as presented.
Move to approve.
Second.
Have a motion and second to approve the 2023 financial audit. Any discussion? If not, all in favor say aye.
Aye.
Aye. Anyone opposed? Motion carries. F, review and motion regarding the reconciliation for the month of July 2024 for the Moody checking account, Moody disbursement, and Morgan Stanley Smith Barney omnibus.
And then Kristen's being the only one on there, which we will talk about later, so.
I think there's actually two
Should be
more on the
There's two more
back.
on the back.
Okay, I was wondering where they were.
Is there two?
I was gonna say, I don't see two
I only
more.
see the one.
Yeah.
On the back of your,
I know that, I'm talking about
Oh.
reconciliation.
oh, I'm sorry.
For the
Yes.
disbursements for the,
So that's only one that's been
Terminations.
dispersed so far,
I'm
The only one that hits this period.
this period, yeah.
okay,
Yeah.
so the others will be next. Gotcha.
The other ones will be in next month.
All right, move to approve.
Second.
All right, have motion and second to approve the reconciliation for July 2024. Any discussion? If not, all in favor say aye.
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 Anyone opposed? Motion carries. Action item G, review and motion regarding the internal financial statements for July 2024. Right at 99 million, and of course, it's grown to 100 million
Mm-hmm.
as of yesterday.
Move to approve.
Second.
I have a motion and a second to improve the internal financial statements for July 2024. Any discussion? If not, all in favor say aye.
Aye.
Anyone opposed? Motion carries. Review and motion regarding the minutes for the July 2024 meeting.
Move to approve.
Second.
Motion and second to approve the minutes of July 2024 meeting. Any discussion? If not, all in favor say aye.
Aye.
Aye. Anyone opposed? Motion carries. And if we want to look at I, J, and K, which is a refund of contributions for Kristen McMillan due to separation. J is review and motion refund of contributions for Christopher Higgins due to separation. And item K, review and motion for the rollover of contributions for Logan Norris due to separation. I will make the motion because I did approve all three of these benefits when you're, had the time to look those over.
Second. Wish them all luck.
All right, we have a motion and a second. And I know some of y'all might still be reviewing, so I'm not wanting to rush anyone.
Good.
All right, motion and second to approve action items I, J, and K, refund of contributions for three previous employees. Any discussion? If not, all in favor say aye.
Aye.
Anyone opposed? Motion carries. Discussion items, upcoming retirements. I know Mr. Scott is looking at the end of September. I don't know if he's
Reached out to you.
reached out to you yet. Good. Nodding, yes? No?
Not so sure.
Okay. I did work with him the other day, and I do know his date is pretty solid at the end of September.
Haven't heard of anything else until next year, as far as I know.
Yeah, I'm the same. Upcoming conferences, we have the Telfer Conference in Irving, October 6th through 8th. If you haven't already, make sure you get with Pam to get registered for that. And our next regular scheduled board meeting is September 17th at 8:30 a.m. I will be out of the country and not be able to attend, but
Angela will cheer it.
there we go.
It will go very quickly.
It will be back, it will be back at the pension office. I hope it does go quickly. All right. If nothing else, accepting a motion to adjourn?
Motion, move to approve.
Second?
Second.
All in favor, say aye.
Aye.
All right, meeting is adjourned.